What if a war between two countries could silently raise fuel prices in your city, increase food costs, and shake global stock markets overnight? This is not just a military conflict. The Iran versus Israel tension is a financial earthquake, one that controls oil, trade routes, inflation, and the future of the global economy. Because in today's world, wars are fought with missiles, but felt through money. On the surface, Iran and Israel appear to be geopolitical rivals, but financially, their conflict centers around something far more powerful: energy. Near Iran lies the Strait of Hormuz, a narrow sea route carrying nearly 20% of the world's oil supply. Every day, millions of barrels of oil pass through this corridor to Asia, Europe, and beyond. When tensions rise, ships stop moving. And when oil stops moving, the global economy holds its breath. During recent escalations, tanker traffic dropped sharply and shipping insurance costs surged, sending shockwaves through global trade. Financial markets react instantly to Middle East conflict. As fighting intensified, oil prices jumped above $100 per barrel, reaching levels not seen since major global crises. Why does oil matter so much? Because oil is hidden inside almost everything: transport, electricity, food production, manufacturing, airline travel. Higher oil prices act like a global tax on every country. Experts warn that a full closure of Hormuz could push oil toward $130 per barrel, risking worldwide inflation and recession. And suddenly, a regional conflict becomes a global financial problem. When uncertainty rises, investors change behavior. Stock markets become volatile. Airline and tourism companies fall. Energy and defense companies rise. Investors rush towards safe haven assets like gold and government bonds. Even rumors of escalation can move billions of dollars within minutes. At one point, global markets rebounded instantly when leaders suggested the conflict might end, proving how sensitive finance is to geopolitics. In modern finance, perception moves money faster than reality. War is expensive, even before reconstruction begins. Iran's economy, already under sanctions, suffered massive oil export losses during previous clashes, losing nearly 94% of daily oil exports during intense fighting periods. Missile launches alone cost billions of dollars. Meanwhile, Israel faces currency pressure, business uncertainty, rising defense spending, disrupted tourism and trade. Both economies pay heavily, but the global economy pays too, because energy disruptions increase inflation worldwide, affecting developing nations the most. This conflict isn't just about territory or ideology. It's about control over energy flows, shipping routes, and economic leverage. If oil supply drops even slightly, fuel prices rise, food becomes expensive, currencies weaken, central banks delay interest rate cuts. One regional war can slow global growth, and that is why financial institutions, governments, and investors monitor every headline coming from the Middle East. History shows us something important. Modern wars are no longer isolated events. They are economic chain reactions. The Iran versus Israel conflict proves that in today's interconnected world, a missile launched in one region can change inflation, markets, and living costs everywhere. Because the real battlefield of the 21st century is not land, it is the global economy.